Go ahead and do that. Welcome everyone to our webinar focused on where are hotel asset values today. Thank you so much for joining us. We have many attendees who have registered who are logging in. Thank you so much for joining us today. As you're getting comfortable and logging in, we'll start with some housekeeping notes and remind you that the webinar today is being recorded. And by virtue of your registration, everyone who's registered will get a copy of the webinar recording. In addition to that, we will also provide LinkedIn bios and information about all of our panelists, as well as our esteemed moderator. And we will also ask for some Q&A. So you can chat with us using your chat feature throughout the entire discussion today. Feel free, we'll be monitoring that on the back end. And you can also send questions via the Q&A feature as well. Based on your preference, we'll be managing both. So we do love to hear where everyone is logging in from virtually. So again, thank you for attending. Send us a chat, please, and let us know where you are dialing in from. We always love to see where folks are hailing from, and many of those who we might know, and appreciate your attendance. A couple of other items. We do want to make sure that you are maximizing your screen and turn up your volume. Always make sure to have those items taken care of. And then one little item that we like is the gallery view. On the top right corner of your screen, you can choose the view options. We would recommend the gallery view. That looks like the Rubik's Cube, and it allows you to see all the panel the entire time. So again, welcome. It just is on the hour at 11 o'clock Central Time. Thank you for attending. We've been eagerly anticipating this webinar. Our last Where Are Hotel Asset Values discussion with the panel was in September of 2020. And so now here we are, January 13th, 2021. I'd like to go ahead and start by introducing our panel and also sharing our screen. So we'll go ahead and do that now. And would love to also recognize that Sales Boost is sponsoring the webinar. We are very proud to do so. We were recently honored and named the most modern skill-based learning platform in the US for 2020. So that's very exciting. And again, very honored to sponsor the webinar today. Kicking off all of our panelists, we have many, many to recognize. And so we'd like to go ahead and introduce first Glenn B. Callison, shareholder with Munch and Hart. Glenn, we are thrilled to have you join us again.
Thank you, Andrea. I'm so pleased to be here.
Welcome. Next, we have Ned DeLorme, acquisitions with Jupiter Holdings. Ned, again, you have been a legacy panel expert, and we appreciate you for joining the discussion again today.
Thanks, Andrea. Good to be here.
Thank you so much. We also have Mr. Gregory Mount. Gregory is the founder of Victory Hotel Group and also executive in residence with Delos. And Delos and its subsidiaries support health and well-being and performance of people around the world through leading research and evidence-based standards, programs, and solutions. A very warm welcome to you, Gregory Mount.
Thanks, Andrea. Pleasure to be here.
Mr. Paul Novak, Managing Director with Whitman Peterson, also a legacy panelist expert, and we're so thrilled to have you back.
It's a pleasure to be back in 2021 and have 2020 well behind us.
Thank you so much. And we have two new panelists joining us today. We are thrilled to welcome Tanya Pearson. She is Senior Managing Director with HVS. Tanya, we're so thrilled to have you join us. Thank you so much.
Thank you so much for including me. I really appreciate it and look forward to the conversation.
Thank you. and William H. Reynolds Jr., Senior Managing Director at MC Capital. Bill, thank you so much for joining us today.
Thank you for having me. I'm delighted to be here, and it's good, to Paul Novak's point, to have 2020 hindsight.
Exactly. Well, and I also would like to introduce our founder and CEO of Sales Boost, and that is Greta Brooks. Greta, we are thrilled to have you join, and so excited to be able to sponsor this this discussion, this debate, this important topic. But then also, you're going to kick off the very first question for the panel as we move into the discussion today. So Greta, welcome, and please continue.
Thank you so much. And Andrea, if you don't mind taking a bow for facilitating this webinar as well. Andrea is our Chief Innovation and Engagement Officer and makes everything happen at Sales Boost. So, all right. So the first pitch question, and I'm very sad we have to wait for baseball yet again. It was fun while it lasted. But the question is, will it come back? Won't it come back? And when? All right. So we'll pitch that over to Paul.
Boy, I wish we all had a crystal ball that was accurate. It really still is very, very hard to tell. You know, we had some positive signs over the summer and into the early fall, and then as Star reported, the numbers dropped off again, and I don't think we're going to see very positive numbers for the first 90 days of the first quarter of this year. But I think if they can get the vaccine out on a much more rapid pace than what they're doing now, I think we might start to see some recovery occurring beginning in the summer, which will be mainly pleasure travel, people finally trying to escape and get some places. I'm not sure we're going to see a whole lot of business travel for a while. I've heard many companies are now not anticipating going back into their offices until after Memorial Day, and even some companies not until after Labor Day, when they feel much more secure that there'll be a much higher percentage of people vaccinated. So I think 2021 is still going to be a slow recovery year, but I do think 22 could be an extremely good and exciting year for us, which probably means that we're looking in some markets at either 23, 24 recovery to 19 levels.
Thank you. Bill, what are your thoughts?
My thoughts are, I generally agree with everything Paul just said. I think that it's not an it's a series of it's that relate to different market segments, as Paul pointed out. So leisure obviously did pretty well in 2020 in general terms. It'll do better this year because of the vaccine and because people just are pent up and want to get out. I think business travel is going to be tough. I was privy to a Marriott survey of 750 of their top negotiated rate clients, not group, negotiated business rate clients. And out of that 750 surveyed, fully 50% still had travel bans extending into this year. So business travel's going to be the slowest, group being the slowest of that segment going forward. But obviously, if the vaccines get widely distributed and work, that's going to start to build people's confidence to be together and not to be as nervous.
Anyone else? I think Tanya, you had some commentary earlier.
Sure. I certainly agree with what Paul and Bill had just said in terms of, you know, the first couple of quarters in 2020 are going to be slower than maybe what we had hoped it would be, you know, looking back 3 or 6 months ago. But in conversations with hotels and CVBs and so forth across the country. It's sounding more hopeful in terms of future group bookings, you know, in the fourth quarter of this year, and certainly much stronger in the years to come. I think once the vaccines are rolled out to the larger population, I think that leisure travel will pick up even more. As we were discussing earlier amongst the group, I think everybody's itching to go somewhere. So hopefully that'll help fuel business for the hotels prior to the return of corporate and group demand.
And perhaps even a combination of leisure / business travel, get some work done and go somewhere and travel. So I know I see a lot of nodding heads. More than likely we'll combine you know, our travel needs in the future. Greg.
Yeah, you know, someone once said that forecasting is part of saying what will happen and then explaining why it didn't. So I think we're all kind of in that same realm right now. I think the only thing that I would add, and I agree with the comments, is that I think June and July of this year will be a real pivot point for us. I think that's when people will be able to look at, you know, what has happened with the vaccines, you know, what's happening from a business standpoint. You know, I think leisure will continue to grow and be a fairly strong segment in general. But I think June, July will be a real pivot point for us and should give us some indication of what the direction is going to be.
Mm-hmm. Yeah, thank you. Glenn, any other thoughts?
You know, I think the optimist in me says it definitely will, and hopefully sooner rather than later. But then the lawyer, you know, comes back with the, you know, response, it depends. And, you know, we've already talked about the, you know, the vaccine and how quickly that rolls out. In one of our prior webinars, when we were trying to talk about this question before the vaccines, you know, were fully developed, you know, we mentioned that unlike prior disruptions to our business, this was a matter dependent on science. Well, fortunately, the science has come through and given us several options on the vaccines, but unfortunately, the rollout of those have not, you know, gone quite as quickly, and everybody's, you know, hoping that will pick up and become more widely available. That, you know, then in turn translates into, you know, renewed confidence among consumers and businesses to, you know, resume more normal traveling activities. But I think there's still, you know, a fair amount of unknowns and uncertainty that relates to that.
I definitely see, we know about the group bookings, and they certainly do seem stronger in the summertime through the rest of this year. So there seems to be certainly a positive expectation of how the vaccine will roll out, and that group business will continue to, you know, move in the right direction. That'll be quite helpful. Ned, any final words?
No, I tend to agree with what everybody said here. My concern is I think leisure travel is probably going to be reasonably good because of pent-up demand. Mm-hmm. The problem really is business travel. And as Greg mentioned, there's just so little clarity on that side. I think a lot of, and I guess, Bill, you mentioned the survey with Marriott. I mean, that's pretty scary if 50% of the companies still have some sort of travel ban in effect. So mm-hmm. It doesn't bode well for group. It doesn't bode well for business travel. There's been a lot of damage done. I don't know when it comes back.
Thank you. And Dr. Wise?
Well, I'm at glasses half full, half full sort of guy. So I have a tremendous faith in the human spirit that we're going to get through all this and resolve it at some point in time. I think it's just imperative on all of us to be savvy. We're all anxious to get out of our homes. We're all anxious to get on the road. We're all anxious to enjoy that vacation that's way overdue at this point. But we still have to be smart and savvy as far as how long it's going to take for the vaccine, the 6 or 7 week process until you get to that point where you're 95% immune, all those kind of issues. But again, I'm very positive in the human spirit. So we're going to win this. It's just going to be probably a little bit longer than we'd all like.
Yeah. Well, thank you. All right, audience, feel free to send us your chat or Q&A so that we ask our esteemed panel to answer your questions and make sure that we hear what is really top of mind from each of you. So feel free to send those in and we'll get to them throughout the session today. Andrea.
Thank you so much, Greta. And Dr. Wise, our moderator, it has such a fascinating story. And Dr. Wise, we're thrilled to have you back as the moderator again today for the topic of where are hotel asset values today. And I'd like to introduce Dr. Wise to the audience and tell a little bit about what you're able to do for these participants in the audience. But Dr. Wise is the co-founder and senior managing director of Turnbull Capital Group in Newport Beach, California, a 37-year hospitality investment banker. He was founder in 1984 of what is today CBRE Hotels during a 20-year stewardship with that firm, and was founder of what is today the hospitality lending practice at Walker & Dunlop in 2007. It's very interesting, Dr. Wise, your Turnbull Capital Group's 15 senior managing directors have some of the most prominent pedigrees in the hospitality universe, each with an excess of 30 years of tenure in shepherding distressed hospitality assets to include new equity and debt placement, hotel ground leases to provide liquidity, hotel and resort asset management, and transactional advisors with an excess of 19.5 billion of borrower and lender executed agreements for workouts, restructurings, and foreclosures in and out of bankruptcy courts. Dr. Wise, you have such a fascinating background. We will also provide that to the audience, but now it's time for your moderation with the panel. Dr. Wise.
Well, that's fantastic. Thank you so much, Greta and Andrea, for a wonderful intro, for providing us this opportunity to get these this great team out in front of the public. And let's get to work here. Again, my name is Dr. Donald W. Wise. I'm out here in Newport Beach, California. Good morning to everybody. I'd like to start with what I call our mantra of the day. And this kind of goes back to my comments a couple of minutes ago. It comes from STR Senior Vice President Jan Freitag, who is head of lodging insights for North America. The current headlines are all positive about vaccines, which are obviously a positive, but we're not out of the woods yet. It's pretty funny. Back during the RTC debacle, I wrote a story that was published in several of the hotel media that was also called, "We're not out of the woods yet." I got kind of a chuckle when I saw that, actually. So let's jump into our crystal ball. Good morning, Tanya.
Hi, Don. How are you today?
We are so happy to have welcome you to our panel. Thank you for joining us.
Thanks.
We have now been in the pandemic since the first quarter of 2020. How has HVS approached the financial projections, and how have those changed amid the pandemic?
So historically, when we would do our financial forecast, we would look at supply and demand on an annual basis. We've now switched that over to forecasting on a monthly basis to better position, the anticipated return of demand, factor in seasonality, new supply, and really take a look at how market segmentation is expected to change over time with the recovery of the market. Segmentation can have a big impact on both occupancy and rate. We talked earlier about corporate demand hopefully coming back this summer and group demand coming back this fall. Forecasting monthly allows us to do that. Also, I think it's important to note that the various segments of the market can have significant rate differences. And by modeling those on a monthly basis, we can illustrate that, maybe there's some markets out there that are going to see rate declines in 2021 if they had, if they had large amounts of high-rated leisure business or high-rated group business in the first quarter of last year. So they're not going to see that this year, so they may be more inclined to have a rate decline this year. Others have more opportunity to grow rate this year with recovery of corporate business. Other changes that we factored in have been our pro forma modeling. Typically, we would look at the past performance of the property on a trailing 12 basis, but we are maintaining our view at 2019 for kind of a stabilized traditional hotel performance level, and using that as a basis for our projections. but most importantly, I think too, is we really have to look at the ramp up of not only rooms revenue from the standpoint of occupancy and rate, but also other departments. You know, how quickly is food and beverage revenues going to recover, and is it, you know, just from outlets first, and then with meeting coming, you know, year or two later. You know, valet parking as well. You know, that's something that many hotels have gotten rid of, and being able to factor when parking is going to return and other ancillary revenues is important to the valuation of a property. And then finally, I think, you know, we're also looking at the staffing levels, and many hotels had to make modifications with their staffing, and, you know, they've been successful at operating efficiently and operating. Conversations with operators have told us that, you know, they anticipate trying to maintain some of those staff efficiencies. So we may see some payroll costs go down in the future.
That's an excellent overview. We're going to come back on several of those points later with different panelist questions. Thank you, Tanya. Mm-hmm. Good morning, Paul. Paul, you're muted.
Good morning, Don.
Good morning. We're all commented. We all love your new logo.
Thank you very much. We're summiting the mountain for big future successes.
That works for me. Roughly 20% of New York City hotel rooms may close, according to the Wall Street Journal, or may stay closed, pardon me. Already hotels such as the W Hotel, the Maxwell Hotel, the 478 guest room, Hilton Times Square, and announced it will not reopen. What does Whitman Peterson expect to happen in other major cities?
Well, I think that we are going to see some probably older big box hotels in major metropolitan markets that may not ever get open. Maybe markets like Chicago, San Francisco could be candidates for it, but I think other markets may have some hotels that simply have reached or had approached their obsolescence and probably are not going to survive. But I don't think outside of New York that the number is going to be really that dramatic. You know, if I had to venture a guess, I'd say maybe 5 to 10% of older big box hotels in urban areas may not reopen, but I don't think it'll be as significant as what's going to continue to happen in New York.
Great, Paul. Excellent overview. Good morning, Greg.
Good morning.
One thing's clear from our industry's history. Revenue recovery is much quicker than profit recovery. What should owners be doing now to prepare for recovery?
You know, I think this is an important question, and I think that there's probably a couple things that stick out in my mind. You know, number one is your data is going to become very important, particularly your short-term data. You know, I think you're really going to need to watch and have the right processes and protocols and fortitude to really understand what's happening in your market and where demand is coming from. You know, I think that even more so than you have in the past, it's going to be extremely important. The other thing is I would say is I think you need to update, you know, your meeting and event policies. You know, I think that, you know, with this uncertainty in committing to meetings, I think you're going to have to be very flexible on short-term bookings. I think you're going to have to provide, you know, attrition and cancellation, you know, fees that just don't exist anymore. And I don't think you're going to be able to get them. And then I think the other thing is that you're going to have to update, you know, your safety guidance at your property and really communicate your cleaning protocols and look for opportunities where you can find, you know, either certification of those protocols and you know, using reliable third parties that consumers will become to recognize as really, you know, the people in this business that are going to look for their safety and well-being. And I think that's going to be very important for consumers to know that at the point of booking. And then lastly, one of the things I don't think our industry has talked about that I think is going to be equally important is air filtration. You know, it is very clear that the airlines have done a great job with their air recirculation and filtration, which is why they've reduced, significantly, the ability when you're on a plane to actually, become infected in that plane, and it's such a small closed environment. A hotel room, guest room is really the same type of environment, and I think air filtration would become very, very important. And there's a few out there that are ones that I think you should take a look at. And then lastly, I think it's a great time to fire up your sales team, and maybe you should start thinking about Sales Boost as a great way to get them back on and focused.
Great comments. Thank you, Greg.
You're welcome.
Good morning, Delorme.
Good morning.
It seems we're all asking the same question these days. Where does Jupiter stand on the tsunami of hotel loans that we've all been talking about? Over the horizon, visible, or not going to happen?
Good question. I think the banks and the special services, from what I can gather and talking to them on a regular basis, are being fairly, especially the banks, are being fairly easy on forbearances and doing workouts. Certainly the larger banks are. Some of the regional banks are being much less flexible. It's been, really 9 months now since we've had this crazy lockdown. Doesn't seem to be any better. I think at some point, particularly the CMBS servicers are going to, have to do something in terms of getting rid of assets and blowing stuff out. We haven't really seen it yet. So I don't know when it's going to happen. I think it just keeps getting pushed down the road, but at some point it's the chickens will come home to roost, and there'll be some liquidations. But right now I think everybody's doing their level best to not do that, except in certain cases, obviously. So it's unclear, but as I think we mentioned before, I think there's been a permanent shift in values. I think the demand curve has shifted tremendously, and that's going to really impair value. So it's a lot of uncertainty out there, but it doesn't look great. That's for sure. Thank God for low interest rates. That's if rates pop up 100 basis points, everybody's broke.
As always, great comments, Ned. Oh, new panelist, Bill. Welcome.
Thank you, Don.
As the panelists know, I actually tried to get Bill on our first panel back in, I guess it was May, but I finally twisted his arm. So we're so happy to have Bill with us today. Everyone on our panel is dealing daily with financially distressed hotel owners and operators. Our markets, hotels, and resorts see opportunities that are compelling to you as an investor and an operator?
Well, that's it's an interesting question, because obviously to the word tsunami before, I think people anticipated a lot of this would happen sooner than it's happening. So my short answer is we have seen some good opportunities. We have bid on several, but to get visibility, which is really what this valuation theme is all about, is obviously very, very difficult. And one has to kind of try to be, as you used the word earlier, savvy about underwriting by market segment, looking at history, looking at what you think is going to happen with everything from vaccines to the political scene. Makes it very difficult. I mean, there are obviously a few bidders who have bought stuff early and in good quantities. We're being conservative in our underwriting as usual, but it's much, much harder now to predict. So you kind of have to say to yourself, in a potential theoretical range of values, if I'm going to invest in distress, or even if I'm going to invest in some of the properties that are leisure that have done better than the rest of the industry, I need to have a range in mind of what's acceptable in terms of returns. Because really what you're saying is, I'm going to get in this today or this year for 3 to 5 years in hopes of getting a significant multiple on my equity. It's not just about a percentage return. And that's very, very hard to predict. And I'm going to add one little in the weeds comment. Greg Mount just made an astute observation about how operations have to change. One of the things that concerns me is the hospitality element of all of this, because the vaccines get rolled out. Let's say a huge percentage get vaccinated optimistically by mid this year. That doesn't mean we're going to be able to stop wearing masks for quite a while, I suspect. And therefore, you're going to have a whole new kind of hospitality approach, because there are going to be people who show up and say, I'm not wearing one anymore. And so all of that's going to factor in over the next, I call it 18 months before we have sort of real visibility. But basic answer, Don, we're starting to see some opportunities. A few have been compelling, but it's not the abundance of deals on the table yet.
No, absolutely. We see the same thing.
You know, Don, if I could add something there real quick. You know, I think that one of the things that's interesting that we're starting to see, particularly in these CBD markets or, you know, the gateway cities, is really this challenge with even the pricing getting down to, you know, a basis that you would think is ridiculous. The ongoing carry cost of some of these is just you can't even model it. You know, we were looking at an asset in downtown Chicago that recently came up, and I think the carry cost was about $4 million a month just to be open, right? And so I think that there's some real issues, and I think if you look at cities like New York, you know, where the government and the state are making it very difficult for hotels and making them pay, you know, huge severances to the unions. I think the unions have not really moved off the needle on their work rules, which is something that's causing challenges with these assets in these CBD locations. And then lastly, the ground leases, I think, prevent you as well from being able to jump into those. And some of the prices are, as I said, ridiculous, but you just can't get to a number, any number, quite frankly.
Right.
No, that's absolutely the case.
Yeah, I would add to both Bill and Greg's comments that I've actually been surprised, and I think most of us on this panel would probably say the same thing, that there has really been very little product that has shown up on the market so far, compared to what I think many of us would have expected. Maybe not the third quarter, but certainly the fourth quarter. And it's just the stuff's not out there. And now it begins to raise the question of whether or not there will be much. We have the second round of PP money that's now going to be available to a lot of hotel owners that has been earmarked, and actually hotel owners and restaurant owners get a greater benefit, can draw down more of that PP money. I think it's 3.5 times versus 2.5 times. So I'm beginning to wonder whether or not we're going to see much product. I mean, between that and the fact that owners seem to be hanging on, and every indication is that most lenders, one way or another, are working with their clients to try to avoid ending up with the properties. And it makes some sense when you think about it, because the reality is in this situation, the lenders really can't do anything more for the assets than probably the owners. And so taking an asset back now just puts the burden of trying to figure out how to carry the thing for the next 6, 12, 18 months, or discounting it so deeply, which they probably don't really need to do, because many of these assets could be back to some reasonable values by 2023. So just an added comment.
Well, no, those are all excellent comments, Paul. You've actually nailed several things we've seen in our past. We saw the approach that was taken during the 2008-2010, and the very different approach where things were marked to market during the RTC debacle, which frankly was the busiest time probably of my career. When
Mine too.
Yeah, we're severely, well, you were with, you're doing your thing, and I was at CBRE at the time, and Mike Brannigan was at Secured Capital. But so we're seeing a totally different approach. Interesting comment to Greg's comment about the cost of carry and so forth. Just for fun, because we happen to be privy to the financials of an unnamed asset I won't mention, we did the analysis, and we figured that based on the cost of carry, the cost to run the property as it was currently performing before it was taken back, et cetera, we brought the analysis in at 120,000 a guest room. It actually closed escrow at 800,000 a guest room. And of course, our 120 was very conservative, but it gave you a sense of exactly what Greg was talking about. Those $3,000 or $4,000 a month negative cash flow between operations and debt. It makes it very, very, very challenging to underwrite, as everyone here has articulated as well. Good morning, Glenn.
Good morning, Don.
So good to see you again.
Likewise.
Your legal practice takes you all over the country, and you're involved with all the different food groups within the hospitality space, whole bandwidth of different types of properties. What segments are continuing to experience the most distress? Which are seeing the most stability? And are any having a bigger come around, a rebound?
You know, the questions, really remind me of a comment that I've heard to describe sort of the impact of this pandemic much more in a general sense. And that's that while we're all in the same storm, we're not all in the same boat. And, that's certainly true as we look at the different segments in the hospitality industry. And it's, not just the segments, but as we've already talked about, the different markets as well, really, are impacting hotel assets in varying ways. So, the ones that seem to have the most stress, we've already talked about, those big box urban hotels, particularly those, in gateway markets that are, dependent on, group business, on corporate travelers and international travelers for their business. And as Greg just mentioned, they're not only seeing no, business coming out of those segments, but they're, having the additional burdens, put on them by, local and state government. So that's an area that we'll, I think, continue to see distress in, for some time. On the flip side, the extended stay segment has performed remarkably well throughout this, and has weathered the storm, quite well, and there's tremendous stability there, with potentially even opportunities to see new growth. The rebound is those hotels in sort of the secondary markets, drive-to markets, and particularly those that have sort of the resort aspects to them that allow that pent-up desire for consumers to get away. While that may be more driven to the weekends and that sort of thing, it's you still are seeing the rebound there. And I'll sort of add to that, it's markets where maybe there are some flight out of the larger urban settings and relocations. I know we're seeing that here in Texas a great deal, but markets like Denver and Phoenix also, I think, benefit from that. And so I think as a result, assets in those markets will rebound perhaps more quickly than those in the coastal markets.
Well, it's interesting. I think the term, drive-to markets probably originated after the terrible, terrible, terrible events of 9/11. And that's a comment that we've used on every single webinars going back to May, is the drive-to markets were the ones that are going to come back. And as we've all seen, we may have missed a few things, but we nailed that one anyway.
Don, I might add to Glenn's comment about the performance and success of extended stay going through this pandemic. We are developing a significant number of WoodSpring suites, and so we've had the opportunity to monitor their performance as well as Extended Stay America. And on the economy extended stay, the numbers have been absolutely staggering. WoodSpring, as an example, recovered to its 19 levels in occupancy by mid-July and have held firm since then in ADR for those properties. And that's a system that has about 300 WoodSpring suites, across the country, their ADR is only off roughly 5 to 10%. And I believe ESA has been performing very much the same way. So there has been one segment in our industry that has performed incredibly well and held up throughout the pandemic, other than for the first few months.
Don, I was talking yesterday with a certain REIT owner who would corroborate everything Paul just said. They were contemplating at the end of 18 into early 19 selling their extended stay properties. Didn't get a lot of interest at the valuations they had at the time, and then came into 2020 to realize that they were darn glad to have those extended stay assets because their full service assets were all cratering around them. And so it's clear that that's going to be healthy for a long time.
Well, as the world is changing, unfortunately, everyone on this panel is very astute and savvy to be able to morph with those changes on a case-by-case basis. Tanya, back to you this morning. Early prognostications from the pundits were that 2023 was where the occupancy was going to come back, and 2024 for ADR. What's HGH's outlook on the occupancy and average daily rate for the balance of this black swan event?
Sure. Well, certainly everybody's crystal ball is a little cloudy these days, and you know, month by month and week by week, we take another look at where our industry's been, and certainly the rollout of the vaccine is a large driving factor for, you know, improvement expected in 2021. But you know, we think that the first few quarters of this year are going to be like second, third, fourth quarter last year in terms of the limited amount of demand. With the hopeful immersion of corporate and group business, we're anticipating that 2021 still going to be down, you know, roughly about $30 less than 19 levels. You know, we're hoping to see more growth in occupancy than rate, just with the return of business, but noting that some of it will still be very price conscious. Future years with the rebound of group business and, you know, more steady corporate business in markets, 2022 and 2023 look more favorable for stronger average rate growth. So our outlook basically concludes with occupancy and average rate recovering to 19 levels by 2024.
Excellent. Paul, we kind of hit on this earlier. Well, we said that 2021 is going to be more fruitful than 2020. It's off to a pretty brutal start with all the shutdowns in Germany and England and California and so forth with the coronavirus. And you kind of hit on this earlier, but we already had it as a scheduled question. Does Webber and Peterson expect to see distressed hotels coming to market in the next 6 months?
Yeah, I think I pretty much addressed it. I do think we will see some stuff coming to market. It's inevitable that there are some owners that simply are not going to have the resources to carry even the daily operating costs, and even if their lender has deferred their mortgage payments. So there will be some stuff. There's no question about it. I'm just not so sure that it's going to be huge volumes of it. And I think the other thing, and we've seen this in a couple of cases where one of our operating partners has bid on a couple of hotels, and we believe that our partner is very savvy, as we are, and has been beat out in every one of those cases, primarily because there is just so much money lined up to buy distressed assets. And some of them have return requirements that are less than others. And so they can afford to basically bid it up. So this is going to be very interesting over the next 6 to 9 months to see if there really is distressed hotel acquisition opportunities.
Well, it's kind of funny that I was thinking about giving you a second question, and you answered it for me. I was going to ask whether the significant amount of dry powder out there could possibly cause properties to sell in excess of what, based on our prudent underwriting, would say the value is. You nailed that. So thank you, Paul.
Yeah, it's already happening. And I wouldn't even venture how much dry powder is out there on the sidelines. It's got to be billions and billions of dollars.
Yeah, I believe
everybody's thinking the same thing.
I believe Prep threw out a number. I believe it was 38 billion.
Yeah.
That's the only number I recall reading in the media recently. Greg, you're up again.
Great.
The leisure value consumer is here to stay. We have seen the rebirth of these travelers with the quote unquote new normal. What segments and brands are best positioned?
You know, it's interesting, as we've evaluated various assets that have been on the market, it's become very, very clear as we've gone, deep into due diligence on some of the projects that we're on, is that the strongest brands and, that we've typically come to know and to love and to understand over many, many years are struggling, trying to pivot, come from their business travel orientation. And it's very clear that the brands that focused on leisure and understand it better are actually succeeding, and you can see it in the numbers. It's really an interesting dynamic. Obviously, OTAs are winning. They have been kind of the long-term price value provider to the leisure traveler. And have been very focused on what that leisure traveler is looking for, from transparency to cancellations to health certification to refund policies, trip insurance, et cetera, et cetera. And I think that they definitely have a leg up. What's going to be important, I think, for owners and operators is to really understand the channels in the shelf space and to really make sure you're on that shelf space. And understand the toggles that you have to flip to be able to succeed in that. And I think that's going to become very, very clear. And those that are good at that, the brands that are good at that, are going to be able to reap the rewards that will be available as leisure travel starts to come back. And I think lastly, I think hotels need to consider opportunities to get extra revenue from the guests, from month-to-month apartment-like units. I think someone was mentioning extended stay. I think that's, we have to be creative. We have to manage what we encounter, not what we expect. And I think, things from providing high-speed internet and desks for people to work at, remote people wanting to get out of their homes and, possibly go to a different location. I think all those things are going to become very, very important. Remember, we're in the real estate business. I think we tend to forget that sometimes. And so it's really going to be about, figuring out how you can maximize your square footage and your asset. And what are other ways that you can drive income?
Well, I will only add to that, we're also in the hospitality business.
Yes, we are.
We have to always have that smile and the good service and do our darndest to make have happy customers that feel like they've received a bona fide good perceived value and so forth. Ned, you're up again. We've been through forbearance 1.0. We've been through PPP 1.0. We've been through forbearance 2.0. Now we're into PPP 2.0. You've been talking to servicers, and we heard your comments a little bit, but go on a little bit if you could about have servicers' position really changed going forward, or what's your crystal ball on that one?
Well, just based, I think you and I spoke about this the other day. I mean, just based on the activity that we're seeing, there is going to be more product available. And, as I'm sitting here, I'm having people send me, inquiries as to special servicer type situations that are available. So, from our point of view, we're really a, opportunistic, distressed investor. So it's been hard to find properly priced deals, given our view, which is buying a hotel right now is almost like doing a development deal. You're not going to have any cash flow for a long time. So if you've got to build that into your model, and that just doesn't bode well for a 5-year or a 3-year type deal. There'll be a rebound eventually, but nobody knows when. And what will the rebound look like? And where will rates be? Where will travel be? We're in this sort of phony war right now. Nobody really has any clarity, and it's very uncertain. And for the most part, the big money guys are waiting. Some of them are buying, and some of the trades that were done last year may turn out to be great. I've talked to a lot of the guys who bought hotel NPLs, and they seem very happy that they bought paper at 70 to 80 cents on the dollar. They may look like very smart guys in 2 years. We just don't know. So that's the problem. It's just there's no clear path. There's no certainty, and values are still fairly high. I mean, we're, as you just mentioned, you saw that deal go off at a 800 per room. I mean, I don't know. It's not for us. So we like the space where we can buy below replacement costs in a market where we see good demand growth, and those are hard to find. So that's my 2 cents.
Absolutely.
Maybe 5.
All straightforward and savvy comments as always, Ned. Bill, you're up again. As Juan Freitag said, the current headlines are all about vaccines. Is Marcus Hotels and Resorts underwriting deals that look any different now that vaccines are becoming available?
No, is the short answer, Don. At this point, I think that a couple of things. One, obviously, the vaccine distribution is slower than anticipated. Secondly, it's very difficult to predict how extensive it will ultimately be, i.e., do you get to the sort of quote unquote herd immunity level or not? And then I was saying something yesterday about, it was a really interesting paper written by Bain and Company last summer or fall called The Great Reluctance. And the point they were trying to make was that even as we get inoculations in place, it's going to take quite a while for people to feel comfortable gathering in different ways. I mean, you see this every day now, and you're going to see it even as we come out of this. And it may be that in some of the smaller markets in the center of the country, or even bigger markets in the center of the country that are, to Glenn's point, easier cities to navigate, maybe that smaller group business comes back in those areas. But for me to say, gee, thanks to the vaccines, we're going to underwrite 2022 and 3 differently than we were 3 or 4 months ago would be virtually impossible to justify. So I guess my short answer is no, not really any material differences. Obviously, if I'm underwriting a property on the California coast or parts of Florida or whatever, it's not going to be because of the vaccine. It's because we saw demand pre-vaccine that might support a little more bullish underwriting. But in general, we're gonna stay on the conservative edge.
Well, I think that's all smart, and no disagreement here. Glenn, you're up again. Many of us feel that PPP 2.0 is too little too late. How much additional help will PPP 2 provide, and is it enough to get us back to stability?
So the new PPP loan program went into effect just yesterday for first-time borrowers. It'll be a bit later for people that might have the opportunity to borrow again. I guess the good news is that it does, as Paul mentioned, provide for some additional help specifically targeted to hospitality and restaurant owners that were, that have been so dramatically impacted, by the pandemic. In the first go around, only about 10% of the PPP money went to those borrowers. So that they've created some new provisions to allow them to borrow up more. That Paul mentioned the 3.5 times monthly payroll versus 2.5 times, for other borrowers. But it's is it enough? And it's sort of begging the question of when do we get to stability, which we've already talked about, and the uncertainty about that. But it does provide some additional help. And so specifically for those first-time borrowers, they can borrow up to $10 million. And there's, some added clarity as to how the program works that simply wasn't there when they rushed the program out in the first iteration. And then there were a number of changes that were continuing to happen after borrowers had already taken the money, and, scrutiny of borrowers that took money, and, borrowers that gave back money. And so what they've tried to do is hopefully eliminate some of that and to give better, sort of guidance to people coming into the program, and some more favorable terms in terms of the forgiveness and the uses that are allowed. That was, again, not simply there, in the first go around. It also allows sort of this second, chance for first-time PPP borrowers to come back in at a smaller amount, though. The maximum, dropped from 10 down to 2. And then there's just the whole clarity about, the number of employees that you can have, and how that aggregation rules work for those. So there's a lot of details there. It's a 5,500 page bill. So you can imagine there's a lot of issues. We are still digging through all of that. But, the good news is for, hotel owners and restaurateurs that, continue to be significantly impacted by the pandemic, there are some additional funds there. Is it enough? Not unless we see a very quick recovery because of the vaccines. And we've already talked about, how that may not happen. Just one last point on the PPP, loan program and some additional clarity there. There are a number of additional restrictions that they've put in place about who is now ineligible to borrow under the program. Namely, you have to have been in business on February 15 of 2020 to qualify. There's now this requirement for a second borrowing that you have to show, a decline at least in 1 quarter of 2020 as compared to a similar period in 2019. You can't be publicly traded. You can't be, a nonprofit. So they've tried to address a lot of the things that came out of the first program that ended up being sort of lightning rods for criticism about, borrowers that, took the PPP money in round one that would, hopefully make that less of an issue in round two.
Well, as always, Glenn, excellent overview. Tanya, you're in a rather unusual situation in that HVS works domestically in all 50 states, including Hawaii. Are there any hotels doing well today from your perspective as far as nationally? And if so, what's driving their success?
So we've certainly seen our share of markets that aren't performing very well at all, but surprisingly, there are markets in property types, specifically, as Paul mentioned earlier, that have been doing very well during this pandemic. Again, going back to economy-oriented properties and economy extended stay, more particularly, have performed very, very well. They're catering to budget-conscious people that are traveling right now, and essential workers, and those in need of affordable housing. So they're well primed to perform very well in this circumstance. We're also seeing markets that are, near national parks, near beaches, in the mountains that have, recorded, record occupancies this summer. People are having cabin fever and they need to get out. They want to be able to drive somewhere and enjoy vacation, but also still have, a wide area surrounding them so that, they still feel safe in the environment. So, places like Jackson Hole and Park City and California and Florida beaches, those areas have been successful this year. It's not to say that maybe their average rate is down this year, but certainly from an occupancy perspective, they've performed very well.
Excellent.
Yeah, Don, I was going to add a point which Tanya has now touched on, and that's the outdoor lodging segment. We're the primary investor behind AutoCamp, which is one of the leading outdoor lodging concepts. And our open auto camps in California, when they were allowed to be open by the state, did absolutely phenomenal. We far exceeded our projected ADRs. The only unfortunate thing has been that California has now twice fundamentally shut down all hotels or any lodging facilities, even outdoor lodging, except for essential workers. So other than that, when we've been allowed to be open, we have just been booming, and we're opening another one in Cape Cod in March, and are very optimistic that that one's going to come out of the box quite fast.
No, those are excellent comments. And Paul and I have had this discussion about glamping before. I think it's really a novel concept, and I think it's a very exciting sort of new part of the hospitality bandwidth of offerings. We're running short of time here, so I'd like to finish up with a question of what we have left. I think it's a great question for Bill. Bill, Marcus Corporation is publicly held and operates two major divisions, Marcus Theaters and Marcus Hotels and Resorts, which are also very involved with Michael Badzigian and Watermark Lodging Trust in Main Street. Could you give us a little feedback quickly? We've only got a couple minutes here of what you've been experiencing between Marcus and Watermark and Main Street. There's a little debrief.
I'd like a 20-second or less answer.
No, you've got 30 seconds, Bill. It's okay.
Let me start with Main Street. So Main Street is a boutique lodging management company and sometimes owner based in Stockbridge, Massachusetts. They exemplify the drive-to thing we've been talking about. And so the majority of their hotels did pretty well over last summer and fall. Everything is in New England. They opened a new property in Newport, Rhode Island called Hammett's Wharf that ran 80% between June and September on 80 keys as a brand new property. On the Watermark Lodging Trust front, obviously Michael and team worked very hard and created a preferred equity relationship with a fund called Ascendant. And in addition, that portfolio has a number of resorts, both on the West Coast and on the East Coast. And as you can predict from everything we've all said, those resorts performed rather well relative to the industry as a whole. And so that was a big help in 2020 and presumably will continue this year. And then on the Marcus front, we have a mix of drive-to resort, urban hotels, and the pattern of our hotels fits what we've all just talked about, which is the drive-to property, the resort, Grand Geneva, north of Chicago, all fared pretty well, relatively speaking, to the industry as a whole. And I think just reflects where we are as an industry. I mean, commercial business is not to be had in great numbers, and leisure business outperformed. And that's kind of a consistent pattern through all three tiers of those companies now.
That's excellent, Bill. Greta, we have time for one last question for the group, or do you want to entertain questions from our audience?
Yeah, I'd love to. There's several questions that are coming up related to, what the new type of hospitality industry will look like. And I think, Paul, we touched on glamping and different things like that. New updates related to Airbnb versus hotels. Owners and operators will need to find a creative way to repurpose those assets now. So this question has come up several different times of, what's on the horizon for hospitality.
Okay, that sounds like a Greg Mount question to me.
You're muted, Greg.
You're muted, Greg.
I appreciate that, Don. Thank you. Look, I think that there's always that old adage that you need to manage what you encounter, and I think that it's going to become very, very important. And I think the goal is to make sure as you reopen as hotels that your losses are not greater than when you were closed. And I don't know that that's really a prolific statement, but probably an accurate one. So I think as you start to evaluate your operating platform, I think you're going to have to work with your brand, you're going to have to work with your teams, and you're going to have to figure out, what are those things that you've offered in the past that guests may not be expecting and that you may not be able to afford. Breakfast becomes a great one to think about. It's always been in our industry, and many of the brands move to, cook to order breakfast versus buffets. You may need to pivot from that. And I think that as we retool, and focus on the guest and focus on their experience and provide them, a safe environment and communicate that to them, which will be very, very important. I think we also are going to have to adapt our operating platform and the services we offer. And so I think you'll see some changes there. But as you pointed out, Don, I don't think, the hospitality side of the business will ever be able to change. And I don't think it will necessarily be sustainable, to maintain the cost cuts that have occurred. I think you're going to have to, allow some of them to return just for what you described earlier in the conversation, which is, providing that hospitality and that warm welcome. So again, I think it's going to be an individual by hotel basis as they kind of vet through this and figure out, what's going to be best for them. Remembering that here in the shorter term, that's a big part of their business is going to be the leisure traveler, and they have a different set of expectations.
Excellent. Greta, you have another one before we close out here?
Yep, we've got one more question. This is from Raul Calvet. So thank you so much. After all the invaluable information you all have provided, I didn't say y'all, all y'all, as well as your vision about the future, which will be your best advice on how we can approach valuation today, considering that our clients have had no cash flows for a year and 2021 looks a bit grim and there's risk. Which multiplier or which IRR is reasonable at this point in time for an investor?
Well, we're going to lay that one on our newbie, Tanya.
Well, certainly, as I'll classify all the time, every asset in every market is unique and different. And, one discount rate doesn't apply across the board to all assets. We've certainly seen discount rates starting to increase from the industry surveys and so forth. During the last recession, those ranged anywhere from 70 to 180 basis point swing up from peak to trough. So we are anticipating that discount rates may change 50 to 100 basis points from pre-COVID levels. So that is one thing that we're factoring in our analysis. Two, I think another thing to look at is you really do have to evaluate how 2021 is going to be for your asset, and if it is really reliant on a market segment that's not going to recover rather quickly, maybe it is worthwhile to take a look at, does it make more sense to suspend operations again, rather than, cover those operating costs that you would have if you were to remain open. We're certainly hearing of more hotels looking to do that again, at least in the second quarter of this year. But from a valuation standpoint, we really do have to reflect a longer term ramp up, looking at reaching a stabilization now. Historically it used to be 2 to 3 years stabilization. Now it's 3 to 5 years for many assets. So it's going to be a longer road to climb, and it really does take, somebody that'll be in it for the long haul to hang on to assets here.
Well, that's a perfect segue, Tanya, because I've got one last question for everyone on the panel. And Greta, you can even answer this too, because you're the boss here. The title of our last 4 Sales Boost webinars has been, where are hotel asset values today? So the question panel is, when do we get back to good old 2019 NOIs? Paul?
Well, again, it's gonna depend upon certain markets, certain products, certain brands even. I think some will come back faster than others. In general, I'm guessing right now, probably 24. I don't think it's going to go out to 25. And certainly some markets could start to get close to 19 by 22. and others by 23. But I don't think even today we still have an idea of when that really is.
That's a great answer, Paul. Mr. DeLorme.
I completely agree with what Paul said. It's going to be very specific to markets. I think the aggregate numbers are not going to return to 2019, at least until 2024. We're going to see a lot of demand. We've already seen demand destruction. I think it continues. I think supply has got to, meet that in order to clear the market. So we're going to see a lot more hotels close, particularly as mentioned before, these big box, full service, older, functionally obsolete boxes that are they're going to go away. There's too many of them. As we've always joked on, we're not overbuilt, we're under demolished, and that's going to be what we see in the next 18 months, I think. So,
absolutely, positively. Greta?
Yeah, I think it's going to take the approach that we just start from the beginning and look at revenues, not really from a historical mindset. We have to really rethink our demand generators and really be savvy and understand our competition, the market, really why customers are traveling to us. And then we really have to determine cost. So really making your team really consider profit and keeping profit margin top of mind and how we're going to get there. Occupancy is great, but if we give away rates as we did in our past 2 downturns too deeply, it takes way too long to come back again. So we have to really make sure that we're pricing things properly, and owners really need to consider that, and that we also are moderating and watching our expenses and making sure that we're not cutting off our nose to spite our face. So it's really going to take some savvy forecasting and budgeting to continue and get back to normal. But again, we've never seen this before. We've had indications of it in the past, but we really have to be savvy business owners at this point and think like owners.
Excellent. Tanya?
I would agree that recovery probably not until 2024. Again, we might see extended stay properties, economy extended stay properties already hitting that or very close to it. But for the broader national average, I would say 2024. There's been mention of cost savings from the standpoint of maybe streamlining staffing and cutting back maybe on some complementary amenities and so forth that I think may lend to some profitability, but I also think we have to be cognizant of rising labor costs across the country too. So even if we are streamlining, we're going to see an increase, and without revenues increasing at those same levels, it's going to be hard to reach those that period of time, that high point in time until 2024.
Excellent. William?
I think I will not echo what everybody said because I generally agree completely. The only thing I will add is that I think during the next 24 to 36 months, the industry's got to pay a lot of attention to what the chief financial officers of companies across the country are telling their internal people about corporate travel group meetings. If you used to go to 5 conferences a year, do you go to only 3 now? There's certain companies that have obviously been healthy through the pandemic, Amazon, but there are lots that have not, and I think that's going to change people's thinking about how they spend their corporate resources. You may have seen, some of the hybrid meetings press today and the trade press for the hotel industry. So I think it's a factor you got to be really conscious of going forward.
Excellent comments, William. Greg?
I don't have a lot to add. I think that we've just had some really great comments around that, and I agree that 2024 is probably the horizon that we look at. I think the only thing I would add is I'm not so sure that we're going to ever get back to the same type of business model that we had in 2019. I think it's going to be a very different model with very different expectations and likely potentially even new or new disruptors are going to come into our industry. And I think we've got to be very, very aware of that. And I will emphasize what Ned said, because I agree wholeheartedly is the reduction in supply is going to have a direct impact to that recovery and what we see.
Excellent comments. Glenn?
So only thing I'll add there is to really harken back to something that you said at the outset, Don, which is that you had belief in the sort of resiliency, and I'll add the ability to adapt that our industry has. And so while it may not be the same industry going forward, I do have a fair level of optimism that we will get back to being a thriving, successful industry that that meets the demands out there for people who want to travel, whether it be for business or for leisure.
Excellent comments, Glenn. Well, I'll close with this thought. I think the issue here, we've all really nailed it our own different separate ways. But as Greta pointed out in our very first webinar that I participated in back in April, there's no playbook for a pandemic. We have paradigm shifts going on right now. And the part of the problem is we won't even know what those paradigm shifts are until they're in our rearview mirror. Mm-hmm. And we can actually articulate and understand them and figure out how to navigate going forward, savvy with prudence, et cetera, et cetera. And my guess is 2024 as well. With that, it's my great pleasure to thank each of you today. Andrea and Greta, as always, fantastic Sales Boost team. An absolutely terrific panel. Thank you so very, very much. And let me just say in closing, let us remember that we're in the hospitality industry, and let's conduct ourselves accordingly. Thank you very much, everybody. Happy 2021.
Thank you so much, Dr. Wise. And to our panel, we really appreciate your expertise and your thoughtful insights. We will be sending out this recording and we appreciate all of our attendees. Really great commentary, questions. We will also include answers that the panel had provided during the Q&A, so that way you can all see the copies of those answers in the webinar recording as well. So thank you, happy 2021, and we look forward to our next webinar in the next couple of months. Thank you so much.
Bye-bye, everybody.
Bye, everyone.
Thank you.
Cheers.
Thank you.